Hello, I'm Tom Matthews, and I'd like to welcome you to our company overview. You're about to hear what we believe is the biggest economic story of our lifetime. I'm going to show you how we're uniquely positioned to capture the dominant market share of what's been identified as trillions of dollars and millions of people on the move. I'm going to introduce you to Transamerica Financial Advisors, Transamerica Financial Group Division. We think we have the financial services business platform to take advantage of this unique moment. Whenever you consider a new business, one of the first things you could look at is the size of the market it serves. You're about to take a look into one of the world's largest industries that provides jobs for 7.6 million Americans. The total financial service industry is estimated at $63 trillion. A significant portion of that is predicted to be moving from where it is today to where it will end up over the next few decades. Does that sound like there might be a business opportunity here? Whether you've been an entrepreneur before or are considering becoming one for the first time, we're going to describe how you might be able to build a business around the unique combination of circumstances we see here and you're about to take a look at. Every once in a while, new ideas come to old industries and completely transform the way they do business going forward. Leaders like Ray Kroc of McDonald's, Sam Walton of Walmart, and Howard Schultz of Starbucks did exactly that. They didn't invent the cheeseburger, retailing, or coffee. They brought a new vision to an existing business, virtually reinventing the way that industry works. When we finish sharing our view of the future of our industry, we think you'll get the same feeling. This is going to be really big. Each generation faces a different set of challenges that can get in the way of achieving its financial objectives. There's an unprecedented amount of people and money on the move right now. If the numbers of both are big enough, then a business opportunity positioned to capture both could lead to what we refer to as demographic inevitability. With the combination of what's happened with the current economy, unemployment, inflation, the stock market, and real estate, just to name a few, and people now living longer than ever, they're looking for answers. What's their next career move, either before or after retirement? What should they do to try to protect and grow what they've saved so it might have a chance to last as long as they do? Where can they get the financial education necessary for the future? In 1945, at the end of World War II, a sailor kissed a nurse in Times Square. That signaled the end of the Great War, and also it seemed like everybody had the same idea at the same time. It was time to start a family. From 1946 to 1964, over 76 million babies were born. Another 2 million people the same age have immigrated to the United States since then. During that window, 92% of the women who could have a baby did, and the average had 4. That doubled the birth rate, which doubled the need for everything their entire lives. Our country had never seen anything like this before. Millions of people hitting every stage of life together. All companies had to do was position themselves to take advantage of this mass of people who all need the same things at the same time. All they had to do was see the next need, be one step ahead of it, and take action. Companies made fortunes by putting themselves in the right place at exactly the right time. Entire industries were created. All of a sudden, 78 million babies needed diapers and baby food at the same time. Then 78 million kids needed toys, their first bike, and then eventually their first car and even a home together. What would have been a good time to be in any of those businesses? I just think that would have been incredible. In our industry, we brought them protection, investment, and retirement planning products and services over the last 3 decades. Everything with this group has been predictable. You can see them coming. For decades, companies and entire industries have positioned themselves to take advantage of these inevitably changing demographics. We knew, for instance, that on January 1st, 2011, the first boomer would reach traditional retirement age 65. From then on, every 7 seconds, 10,900 a day, 4 million people a year reach this stage of life all the way until 2029. We see a great need for professionals to educate them about their money, which has led us to our expanding our firm today. We hope you start to see the future trend here. These have been and still are difficult times for many. According to a recent Allianz survey of adults aged 44 to 75, when asked the question, which do you fear the most, 2 out of 3 said outliving my money. People are more worried about that than dying. We have strategies that can help clients whether they're concerned about dying too soon or living too long. Just like they were born within 18 years of each other, they're now going to retire within 18 years of each other. This group controls 70% of America's wealth. Yet, according to a recent study, almost 2 out of 3 don't have a financial advisor yet. In this era of longevity, they're going to average another 25 years of life, some even longer. This brings up the question, what are they going to do to make sure their money lasts as long as they do? They need to protect first and then grow what they have. They're shifting from accumulation to income distribution. The amount of wealth on the move is estimated to be as much as $52 trillion over the next few decades, according to Boston College's Center on Wealth and Philanthropy. They might even be looking for new ways to earn money, like an encore career or even a whole new chapter of life. Past generations usually retired with a combination of a company-sponsored pension, a Social Security check, and their personal savings. Over the course of my 3 decades in this business, there's been an incredible shift to personal responsibility. First, receiving retirement income from your company is becoming a thing of the past. The percentage of workers covered by a traditional pension plan that pays a lifetime annuity, which is usually calculated based on years of service and final salary, has been steadily declining over the last 25 years. Second, in 1945, there were 42 covered workers for every 1 retired. By 2012, that was down to 2.8 to 1. According to a recent government report, high energy prices and our slowly rebounding economy are shortening the life of the trust funds that support Social Security. As it stands now, it's predicted that funds are going to run out by 2033, 3 years earlier than even expected. If these funds are exhausted, the program would only receive enough in payroll taxes to pay partial benefits. And last, the stock market has experienced 2 of its biggest drops ever in this new century already. I'll tell you more about that in a few minutes. Although the market's doubled in value since March of '09, many people still fear putting money into it, and instead are losing out by moving their investments to cash-type accounts that earn little, sometimes even no interest. This fear could possibly cause them to have to put their dreams on hold, or maybe even give them up on altogether. These trends threaten to shake up the American retirement system as we know it. All of these changes have led to a clear shift to personal responsibility when it comes to investment and retirement planning. People are looking for ways to give them the best possibility of their money lasting as long as they do. There are seemingly endless obstacles and issues to finding simple and efficient ways to put your money to work for you. There needs to be a solution that can help you manage your money and help you work towards a more sound financial future. People have to learn the right balance between what they spend now and what they save for later. There's the very real possibility you could spend as many years in retirement as you did in the workforce. A financial education is simply critical. Where are people going to get this education? Well, it usually doesn't happen in school. As of 2011, there were only 4 states that required a 1-semester course devoted to personal finance in high school. What about the rest? Is 1 course enough? Compare that to over 9 times that many states that require sex education in high school. What does that say about what's important to us? How will people learn how money really works? We teach people financial concepts like how compound interest might work that helps them choose the right strategy for themselves. Understanding mathematical concepts like the power of compound interest can make a huge difference. We want everyone to have the opportunity to learn concepts like this. Here's a great example. Take a $1,000 one-time lump sum over 70 years at different returns. The difference can be amazing. $1,000 at 5% grows 30 times to $30,426. If the return doubles to 10%, what do you think happens? Does $30,000 double to $60,000, or could it be more? $1,000 grows 26 times to more than $789,000 at a steady 10% rate of return. The difference between 5% and 10% is 26 times the money. We want people to understand the difference rates of return can make. And what happens if you get just 2% more? Would you be surprised to find out $2.7 million? Understanding financial principles like the power of compounding is so important. Knowledge can be very powerful as you build your financial future. Also, please remember the return and principal value investments are going to fluctuate over time. But another important principle is the impact of losses. The more you lose, the more you have to gain to get back to even. If you lose 10%, it takes 11% to get back to even. If you lose 30%, it takes 43%. If you lose 50%, it takes 100% to get back to even. Why is this so important for people to know this? Well, according to a recent Dow study, the average equity investor underperformed the S&P 500 index by 4.32% a year average for the last 20 years, as well as underperformed for the last 1, 3, 5, and 10 years. Take a look at how the 20-year annualized returns of the average equity investor and the S&P have done over the years. In 2000, the gap between the long-term annualized returns of the average equity investor and the S&P 500 was 2.5 times larger. The average equity investor underperformed the S&P 500 each year since '97 on an annualized basis. For the average equity investor, it's been a tough last few decades. To understand how the average investor has had such a challenging time recently, you need to take a look back at history. This graph represents almost 18 years in the S&P 500 stock index from August of '82 through March of 2000. 93% of the index's total return performance up to that point occurred during that period, which averaged over 16% a year. You didn't have to be an investment professional to be successful, you just had to be in. Then the 21st century began. How have equity investors done since then? Well, after the peak of the stock market in early 2000, it's been a roller coaster ride for most of them. Take a look at the S&P 500 and take a look at the red zones there. A minus 49% and a minus 56% drop. The green zones show over 100% increase after each drop, but can you see the need to be both defensive and offensive as an investor? After all those ups and downs, the S&P 500 index is still below where it was at the 2000 peak without dividends. The positive returns after each of those drops was not enough to make up the difference. Adjusted for inflation, it's even lower. Are there any strategies available that can help investors during volatile times like these? Well, let's take a look at two different money management strategies. The first is called passive management, otherwise known as buy and hold. Passive management is a strategy for investors to manage risk by allocating investments among a broad array of asset classes and then holding those assets for an extended period of time regardless of market conditions. The theory behind this strategy is that markets are efficient, which suggests that the price for security is the fair value price. Passive management investments offer this diversification and low expenses and tax efficiency, but they don't defend against down markets and they don't even attempt to beat the index returns. Another money management strategy is called active investment management. Active management is a strategy for investors where their portfolio holdings are adjusted on a continuing basis in response to market and economic conditions. This strategy offers a potential to beat the market by exploiting inefficiencies in pricing. And in theory, this strategy has the ability to defend against down markets. The decision to choose active or passive money management styles should be made in the context of your overall investment objectives and ability to tolerate risk. You could even choose to use both strategies in a balanced approach to help achieve your overall investment goals. The recent financial crisis showed investors, especially retirees, the dramatic impact a stock market decline can have on holdings, especially at a time when they need access to their investments. With life expectancy increasing and markets fluctuating, investors need help managing their money in these tough times. Our third-party money managers practice active investment management, monitoring accounts and moving money as they deem appropriate. We believe this strategy can help our clients reach their goals in both up and down markets. Markets are always going to go up and down over time, and no manager can buy at the absolute bottom or sell at the very top all the time. But what they can do well is identify trends. As the trend begins to head down, they can become defensive. As the trend starts back up, they can become offensive. That gives your account the opportunity to respond to market conditions as opposed to a passive approach of just buying and hoping. What we look at are things like their cash flow, emergency fund, and debt management. Then we look at their assets and help them make sure they're protected in the event of premature death. Through volatile markets all the way to estate preservation and family legacy. We're here to help these individuals and families make informed choices and take steps towards achieving financial independence. Intuitively, you know that taxes reduce the earnings you retain. Another way to look at it is to see the effect it can have on the monthly amount that you have to put aside to hit a goal like $1 million at retirement. An account earning 8% with no tax deferral needs to save $1,179 a month for 30 years. With a tax-deferred account, it requires only $706, $473 less per month. Another thing we look at is that time can be your worst enemy or your greatest ally. No matter where you are in life, the key to building an asset accumulation program is to begin saving now. The sooner you begin, the less money you have to put aside to create solid savings for your future. Here's an example of how that monthly amount required to reach $1 million for retirement changes with how much time you have to hit that goal in an 8% tax-deferred account. We encourage our clients to put time on their side by starting as soon as possible. With our needs-based approach, we protect families through the use of life insurance and annuities. We're driven by our mission to help families achieve financial independence. So we have agreements with some of the most well-known and well-respected companies in our industry. Our company does not have a one-size-fits-all attitude regarding products and product providers. We advocate the power of choice for our clients. You aren't limited to one type of product, one type of service, or one company. We can help you choose the ones that best fit your needs. We also help clients with their investment advisory needs, and so here's some of our third-party investment managers, which you can choose separately or choose through our Transamerica Wealth Management Strategy platform that can help guide you to the appropriate strategies for your risk profile. We're dedicated to serving people from all walks of life with an individualized investment strategy. Creating the right financial strategies, not only for the rich, it's an opportunity that should be available to all people, no matter what their income or net worth. A series of investment news articles from a few years ago said that as more and more people are in need of investment advice and the baby boomers begin to retire, but surprisingly the number of financial professionals has dropped. At the time of this report, one investment advisor firm proposed that another 50,000 advisors would be needed to handle the large amount of retirement assets that will be hitting the marketplace over the next few years. The same investment news article discussed the potential shortage of advisors. Many advisors are retiring now, but many new ones may be drawn to this career because it can be a well-paid career and it's really stimulating. The article said the key to attracting new advisors might be to talk to the 30 and 40 and 50-year-olds who've been downsized from corporate America and looking for a new career, maybe even 60 or 70-year-olds. But as Bob Patrick said in a recent article in Advisor One magazine, the need for new advisors is critical, and it's about to get massively critical. So, your first option with us is if you like what you saw, you can become a client. You know, if you like what you heard in this presentation and you think we might be able to help you with your money, we're happy to sit down with you and show you how you can take advantage of our investment strategies and help you move towards financial independence. Next, you could consider beginning a new career with us part-time. Keep doing what you're doing now and add this to it as a twin career. Then, either through success part-time or industry experience or success, you could consider doing this full-time. You could build a business as big as your commitment and vision. We have many ways to make money and become as successful as you're willing to work hard for. The only limit is how big you think, and then build your business from there. One success goal that many people have is attaining a yearly recurring six-figure income. With a traditional income model, you have to work hard and save enough so that if you could get a 10% return, you could have a six-figure income. This hypothetical example illustrates saving earned income of $1 million and then investing at an annual 10% rate of return. Please keep in mind that investments like this can fluctuate, but assuming this rate of return, the investment would produce $100,000 in passive recurring income each year. If you're starting now with nothing, you have to save $1,300 a month for 20 years. How likely is that to happen to you with what you do now? And what would you say if you thought there might be another choice? Well, take a look at our advisor model where you work hard and accumulate as few as 150 average clients to achieve the same six-figure passive income. Our third-party managers manage the money and you maintain the relationship with your clients. Any account growth can increase your income as well as any other products or services your clients might need. Have you ever heard of a business that allows you to help this few amount of people and be rewarded so well? We also have leadership possibilities available if you're interested in accelerating this even faster. Which of these examples is more likely to happen to you? When you get back together with a person that invited you to watch this, ask them to show you all the income potential this business model really has to offer. You know, if you're looking for a career in the financial service industry, we think we're the company for you. Transamerica Financial Advisors has been in business over 25 years. We're different by design. We combine the dream of becoming an entrepreneur with the crusade of teaching the financial principles necessary to prepare our clients for the future. We're also driven by the incredible demographics of this era. We anticipate the next big need and recognize the markets we can make a huge difference. All of that can lead to what we're going to describe as our decade of dominance in this industry. We think the potential for what we're going to do and for the future is unlimited. You know, there's many reasons to choose us. Our back office is powered by an industry leader, which gives us and our associates unlimited growth potential. This is a chance to help others and yourself at the same time. We want to help you decide which options are right for you. We have some additional information for you, and we'd like to set up a follow-up interview in the next day or two. A good opportunity only becomes great when you act on it. You know, many goals and dreams in life require having enough money to achieve them. Whether you look at buying a house, sending your child to college, or retiring comfortably, each requires a sound strategy. But most people are uncertain when it comes to finances. You've heard it all before. Plan for your future. Most people end up having to shrink their dreams to fit the size of their opportunity. Well, I'm here to tell you this is an opportunity as big as your dreams. Don't sacrifice tomorrow's dreams with today's inaction. You know it's important to start now, but you've got to take control of your career, just like your money, and make it go to work for you. Most people simply don't know where to begin. Well, I'm going to suggest you begin with Transamerica Financial Advisors. No matter what your life looks like today, achieving your dreams is possible. Whether you're a potential client or looking to become an entrepreneur, we have the products, we have the services, we have the business model, we have the leadership, and I think we have the opportunity that can help you. We can help make your tomorrow the best it can be and look forward to exploring the future with you. I hope to meet you in person one day and appreciate your time. Thank you.